First of all, I would like to show our respect and acknowledge the traditional custodians of the land on which this event takes place, together with their elders past, present and emerging. Thank you very much for the introduction. Tim Heenan, partner in Deloitte, restructuring service, turnaround and restructuring. Bit of further background, I'm Queensland born and bred, grew up out in the Lockie Valley on a potato farm, and typical agri-succession story. Parents told me not to come back on the farm and study hard because there was no future out there, but anyway, there's a bit of feedback. That better? I've been in the restructuring game for the last probably 15 years of my career. I joined Deloitte in London actually before transferring back here. But more predominantly, probably around the mid-2010s, started doing a lot of work with financiers, looking a bit closer at exposures within the building and construction space. And so that's where my sort of first real foray into understanding the building sector came through. So primarily I've been asked to just provide a bit of insight in terms of, so in restructuring, you've got the formal restructuring side of the business and the informal restructuring side of the business. Yes, I'm a liquidator, don't hold that against me. But the formal restructuring side of the business, I'm sure the people in this group are well aware of it, so I won't delve too much into that. The informal side of the informal restructuring side of the business is something that we do. We believe we do pretty well. It is a bit more, it is quite flexible because it's not regulated and it really depends on what the client needs. There are aspects to it, safe harbour, and there are certainly the bad side of it, which I'll touch on around some of the Phoenix activity that you hear about as well, and think of some of the warning signs. But in terms of the current sector, again, no surprises here. You look at the headlines over the last few years, and clearly the building sector's been under quite a bit of stress in an environment of fixed price contracts, labour supply shortages, input cost increases. Clearly the builders getting a bit squeezed in the middle, and causing failure, which then flows down into the suppliers to those particular builders as well. Those builders that have a strong balance sheet may be able to withstand this, and I think in time will thrive. But if you don't have the balance sheet to withstand losses on contracts, one or more contracts in the portfolio, clearly there's going to be a crunch and potential failure, which we can see there. The insolvency statistics also bear that up as well. You can see some of the post-COVID hangovers and the insolvencies start increasing around about that 2022 period, both nationally and in Queensland in particular. I picked this off a presentation I did a little while ago. I know this is a national body, of course, but it's just got the Queensland stats in there. But I think if you look around the country, you'd see the same trend. So now just sort of talking a bit about the formal and informal restructuring. So by the way, please jump out. If you've got a question, please ask along the way. It makes it a lot easier for me, but please speak up. It's a relatively small group, so we can, people can speak up. So the formal restructuring side of the business, people know VAs, receiverships, liquidations, bankruptcy and the personal side of things. There's a sample of some successful restructurings that we've been a part of over the years, so from the likes of Virgin to more of the building space customers. I've been involved, particularly BCP Precast was some time ago, which some people might know. Scooter Group is a more recent one, a sale of a plastering business we undertook in receivership based on the Sunshine Coast. And your ProBuild and Cloughs of the world you would have heard about. Very regulated, you're appointed, you're independent, you're governed by the Corporations Act. You can successfully restructure in formal appointment. It isn't the end of the business, but it is probably, the stats would show that most companies that enter into an insolvency process, it is a shutdown if you look at the whole portfolio of insolvency appointments. And the informal restructuring side of the business is really you're engaged by the client to assist them, and in our side of the business, it's in a time of need. Every practitioner or every group will call it something different. We split it into what we call special situations and value creation services. Special situations are probably further down the distress point of the curve, where directors or shareholders or management of the business recognise that there is a crunch coming up. There might be in the building, and there might be a large contract that's gone very poorly, and they don't have the. Yes, sorry, you go.
I just wanted to confirm for myself, the informal restructuring is what's been happening in the last year, more so? Is this where I thought this was going to be strictly about restructuring practitioners. I've had two go into a restructuring practitioner method in the last year. Is this what you're talking about?
So when you say restructuring, there's small. Are you talking about the small business restructuring?
Yes,
yeah. So no, this is more about the informal, about the client side of the business. The small business restructuring is a formal process that happens outside of that. That would more fall into the formal restructuring. So insolvency, voluntary admin, DOCA, receiverships in small business restructuring as well. The informal restructuring side of the business is very much you're engaged by the client. They may have actually reached a bit of a credit crunch, and they need some help and assistance in terms of working that through. So whether that's actually entering into some sort of accelerated M&A proposition, often we get engaged in terms of going in contingency planning in advance of a potential appointment. ProBuild and Clough were examples of, because they were so large, there is a benefit to actually going in there and getting an understanding of the business before you're actually appointed as administrators or an insolvency practitioner. Managed exits, shareholder disputes, safe harbour is something I'll touch on a little bit as well. And what we also call value creation services, that's probably a little bit prior to that end of the stress curves, where the business really wants to focus on, can we actually turn the business around, as opposed to in advance of maybe an insolvency event. And you're working with management to try to identify some initiatives to immediately improve cash flow, improve profitability, so you can actually right-side the business and avoid that insolvency process. There are some distinguishing aspects between them, which might be the headline items. Who's your client? Formal appointment, you're independent. You're governed by the Corporations Act and insolvencies. Informal appointments, more flexible in terms of who your client is. It's often the company, directors or shareholders. Public, formal, it's public. It's filed with ASIC. Anyone can search it, and the headlines hit the papers. Informal, no. You're a consultant to the business. There's a few other things as you go through there to point out. Probably the important thing is regulation. The formal appointments are heavily regulated. We've got the industry body, ARETA, TMA is another one that we work with. ASIC is the regulator, and they are very active in making sure liquidators are actually meeting their obligations. Whereas on the informal side of things, it's not really regulated at all. You might have industry bodies. I'm a chartered accountant, so I'm regulated in terms of the CA, but in terms of actual informal, in terms of the actual informal appointments, no, they're not regulated at all. And also the engagement durations. Corporations Act, there are some timeframes with the voluntary administration that you need to play to. Informal can be short, can be long. I'm involved with one at the moment, which is a 5-week process. It could be extended depending on how that plays out as well. I'll just sort of quickly touch on safe harbour. Safe harbour sits in that informal bucket as well. Safe harbour is enshrined in the Corporations Act. So that provides directors, as you see there, who suspect companies some protection. So in the ordinary course, prior to safe harbour coming in 2017, a director's only defence against potential insolvent trading or against directors' breaches was appointing a voluntary administrator. Now, the government at the time, I think it was Turnbull government at the time, thought, and I do agree, I think the safe harbour is a positive thing. It hasn't been used, I think, it hasn't been used or tested too much as yet. But they thought that there were opportunities to turn around a business, which is the benefit of creditors, employees and the economy more generally, that were being missed because directors might preemptively appoint voluntary administrators. So safe harbour legislation came in. There are some criteria to which directors need to meet in order for safe harbour to be eligible. Key ones are employee entitlements, including superannuation, are up to date, and the taxation reporting obligations are up to date. If that's not happening, then you're not eligible. A lot of the companies that we walk into, things like statutory obligations, the reporting isn't up to date, or superannuation isn't paid, and therefore they're not eligible to start with. And then the other key point is the better outcome test. So the action that a director is implementing when they're in safe harbour has to lead to a better outcome. Has to have reasonable prospects that aren't fanciful, that it will lead to a better outcome for creditors than if you appointed liquidators on that particular day. As soon as you do not pass that test, or one of these eligibility requirements aren't met, you're not under safe harbour protection, and you need to you'll need to appoint voluntary administrators to otherwise avoid those insolvent trading and directors' breaches. The other interesting about safe harbour, which is debated quite heavily, would be interested to this group, is in terms of disclosure. There is no requirement, and you think about a listed company, continuous disclosure. There is no requirement to disclose that you've appointed safe harbour. Some directors and companies do choose to do it voluntarily, so that the market knows and creditors know that they are protected before they may go forth and try to sue them, but you actually don't need to. What I'd say for a listed company though is the events leading into the requirement to get safe harbour protection, whether it be poor financial performance, getting sued on a matter, environmental disaster, those things would all be disclosable. So in my view, there would be, most of the time that I've been involved in a safe harbour on a listed entity, you could read the disclosures and you'd know that the directors are getting safe harbour advice, or if they're not, then they should be. It would be reasonably obvious. In terms of the other part of special situations, other ways we do it, accelerated M&A, contingency planning, which was spoken about. This is a part of the business as well where secured creditors will often engage us to understand their exposure to borrowers and their options around that as well. Shareholder disputes is something that's becoming more common. And indeed, if you look at some of the larger, the Cloughs and the Pro builds of the world, they're situations where foreign shareholders actually withdrew their support of the local business, which caused the local directors to actually appoint. That was their only defence at the time. And the likelihood of going to safe harbour and getting a special outcome when you don't have the funding on a business of that size is, you'd probably say, would be fanciful from the outset. And then we talk about our value creation services. So this is more about where you actually go in, where businesses are actively trying to turn it around, whereas in special situations it's often, we are right at that point. How do we best exit this for the benefit of creditors and shareholders? So we look at financial and operational improvement, cash working capital improvement, and on the other end, where there's more runway, strategic repositioning and transformation. What I'd say about this type of situation is the more runway you get, the better the opportunity is for actually implementing a good turnaround plan. If you're right at the point where all of a sudden you're an ATO payment plan, statutory demand's being served, it's too late at that point in time. It's very hard to turn that ship around unless you've got a friendly investor at your beck and call. If you don't have that, then the more runway you have and time to implement identify the opportunities and implement a turnaround plan, the greater the chance of success. And it's hard for businesses, right, when directors, family-owned businesses, to actually reach out and ask for help and acknowledge that there might be some failings. It's human nature. You leave it until the last minute before you've exhausted every opportunity yourself before you actually ask for help. Any questions at the moment before we touch on Legal Phoenix activity? I thought we'd touch on. I wanted to touch on this, and this is only something I added last night as well. The ATO and ASIC have really focused on illegal Phoenix activity, and it's probably, I see it more prevalently in the building and construction space, I've got to say. Now, everyone knows that Phoenix rises from the ashes. So essentially what a director is trying to do, it's often the director, maybe the shareholders, they're essentially trying to lift the value of assets in an insolvent entity. They're trying to lift the valuable assets, the trading business, the underlying plant and equipment, the debtors sometimes, lift it out of that entity and put it into a new entity and leave all the liabilities behind. So we have been involved in this situation actually quite recently, where you step in, and we were actually appointed. We were appointed receivers by a bank, and there were sale agreements on foot that had not yet settled for the transfer of the assets. They may or may not be the new shell entity may or may not be taking on liability for employee entitlements. The customer contracts are being transferred. But all the liabilities, and statutory liabilities are often the main one, are being left behind in the old entity. And that is essentially what an illegal Phoenix, what a Phoenix is trying to do. There are some pretty clear, and ASIC have actually issued some guidance for people in this room and suppliers to these types of companies to look out for. And I'm sure a lot of you would have seen this. You would have seen these, and it was interesting. We use this when we're under an obligation to report to ASIC if we suspect these types of things, and we use this checklist to actually go through. The company fails and cannot pay its debts. The company changes its name, it all of a sudden becomes XYZ Proprietary Limited to ACN 1, 2, 3, 4, 5, 6, 7, 8, 9 Proprietary Limited. And a new company is registered with the exact same name. Directors or former directors transfer the assets from the old company to a new one. Now, interestingly, depending on the structure of the business and the creditors, of course you need, if you've got a secured creditor in there, you actually need consent of that secure creditor to transfer the assets over. So you just can't do it in this day and age with secure interest on the PPSR. To actually validly transfer title, you need the consent of the secure creditor. So I probably see this more often where there isn't that secure creditor involved, and in smaller businesses. The new company, for all its intents and purposes, it's exactly the same business, same premises, same people, doing the same thing. Same bank account. I probably don't see the same bank account actually being used, to be fair. They normally change. They normally try to change the bank account, I've got to say. But the advertising material, websites are generally all the same. The bank account's actually changed as well, although it might still be the same name. And the same people involved, managing the old company and controlling the new company.
Can I ask you a question? So you're saying as a liquidator,
Yep.
if you suspect this,
Yes.
it's an obligation.
Hello? No.
Yeah, I can hear you. I can hear you perfectly.
We have a situation where a liquidator has been appointed to a company.
Yep.
The company was engaged in a large commercial job. The liquidator's gone in. A Phoenix company has been established, and the liquidator is working with this new company on the same commercial job, using my product, secured creditor, under the original company.
Yeah.
So the liquidator really should be.
Yeah, so we have an obligation, and it was the liquidator is an independent party, and we are independent, and look, there's careful I say, but there's rogues in every sector, right? I'm can't sit here and say that 100% of my profession operates within, but that's the same within every sector. The liquidator is there to be independent. So we, if I get appointed as a receiver, liquidator's got to do investigations, and we suspect all sorts of breaches, but focusing on illegal Phoenix activity, we are required to lodge a form with ASIC, and it's a standard form which says, tick a box and we suspect illegal Phoenix activity. And what will often come back, you'll very quickly get back a request for a more substantial report, which we're obliged to complete. And ASIC will investigate that as well. But also as a liquidator, you have various options to unwind uncommercial transactions, for example, and for the benefit of creditors. Your primary obligation is to the creditors of not shareholders, because by that point in time equity is destroyed. Your primary obligation is to the creditors, and it's really a judgment call in terms of, does a winding of that transaction, it depends on the size of the price, for want of a better term, does unwinding that transaction and getting it back into the business, and then if it's in liquidation, generally it's shut down, and then realising that for the benefit of creditors and the costs involved in that, is that a better outcome for creditors? Or often what you might try and do is actually try to get value for that asset, because that's a key thing around illegal Phoenix activity, is there hasn't been valid consideration paid for those assets, or what they've often tried to do is offset it against liabilities which might benefit one creditor, which is often maybe a related party loan, but it's not for the benefit, it's not distributed across for the benefit of all creditors, which is what a liquidator is meant to do.
In our situation where directors for this company liquidation, a new one, just ready to step in on this job, we stripped down the previous job and all our material was here, and the liquidator is allowing this same director to help himself to our material, which is under PPS.
If you've got a security interest, yeah. You might be, there's some steps you should be certainly getting a stock take on what materials are there and holding.
A stock take,
Yeah.
but because it's in an unsecured place, my understanding was the liquidator should secure that stock, but he's allowing his director to help himself to our stock and finish his other job under a new company name.
Yeah, I think there's certainly a case there to get consideration for that unused stock. Is generally speaking, if we're appointed to an entity as an administrator, receiver, or liquidator, and we use a secured party's asset, inventory in this case, or it could be cartridges out of it could be anything. We are required to pay. We need to pay for that use, and that's fine. If you pay, you pay for it. I mean, in our practice, we would be speaking to creditors before that, making sure we get stock takes and get agreement in terms of what's there, because sometimes you don't want to get into an argument about that after the fact.
This is where we are, because we did a stock take a
Yeah.
few months ago, and we don't know if the exact amount of stock is still there because they're helping themselves to it. So.
Yeah. Yeah, and there's some other aspects, and I didn't put this up there, but there are other things in terms of what sort of parties are involved in a Phoenix activity. You'll have a valuer doing valuations of assets in order to try to show that valuable consideration has been paid. You'll have a liquidator, and I think ASIC and the ATO website just says a friendly liquidator. You'll have you might have some directors that step in, dummy directors on the old entity. Generally, the same ones go over to the new entity, and there's a couple of other parties involved that I can't really recall, but solicitors involved to draft sale agreements, for example. So there's a lot of resource, and there's actually a hotline to report it to the ATO as well. But there is an obligation on liquidators, and I've done this a number of times where you step into something. It may not be immediately clear, but if in doubt, report, because as I said, we're very heavily regulated. So if ASIC come in and which do a review of the file and say you should have reported that, we want to make sure that we've reported it.
Would you report that to ASIC if you weren't getting satisfaction through the liquidator?
We can ask ASIC. In terms of the supplier directly.
No, we need it for the recording.
Yeah.
You can hear it in the room, sorry, but we need it for the recording, they can't hear it.
No, that's fine. Yes, that's an opportunity. There's also industry bodies as well. So I'm a member. Whilst ARETA, for example, doesn't regulate liquidate, I'm a member of ARETA. So if creditors have a complaint about me, they can also complain to ARETA. So there's various avenues. Happy to. It's easier. I much prefer having the question. So I think that's the reason I wanted to touch on.
Sorry, Tim.
Yeah.
Marie has a question.
Sorry, I was just going to ask a quick question. Has anyone here ever reported through the hotline for illegal Phoenix activity? And I'm just saying this because we would have had 2 in the last month that were clear Phoenixes, in my opinion, even to the point where the rep was telling us this customer is one of the biggest roofers in, where was this, Victoria or South Australia or something? Queensland. Sorry, I can send that through to you. One of the biggest roofers. I've been meeting with them for months. They're huge, and we look at it and we say, well, actually, no, the caveat's on her property from the guarantee that she'd signed in the other business. They're using the same trading name. It's a different company. No, we didn't report it. That's on me. But does anyone else here actually report them through to the Phoenix hotline?
While you're thinking about that, it's an interesting point, because if the name's the same, the website's the same, the people are the same, I mean, I'm not going to be reviewing every different ACN that comes through every time. It's easy to miss. The things that might come to you is all of a sudden you get a letter asking for, changing the bank account details to deposit if you're on the customer side, to deposit the funds to. Those are the types of things that you might start, or on the supplier side, you may not see it. You may get a request to update the ACN of who your actual customer is. perhaps. Those are the types of things
We
that
got
you
a
would
letter.
notice.
So we got a letter telling us that please ignore the adverse on my business file at the moment. It's a mistake. And when we dug into it, it wasn't a mistake. It was due to the guarantee on the company that had just gone into external admin 2 months before.
Yeah.
So the whole story stacked up, even the fact that it was my competitor who was chasing them for money, and I did call and confirm that with another bureau member. But I was just curious as to whether anyone does actively use that hotline at the
I
moment.
don't.
It's the
Is
ATO.
everyone
It's an
aware of it?
ATO
Yeah.
hotline.
I'm not aware of it.
I can. I'll dig it. Some people you obviously know about it, but I'm happy to circulate it around. It's on the ASIC website. The ATO hotline is on the ASIC website, so you welcome to happy to share that around. So yeah, the reason I wanted to touch on that as well is because, the focus on this was about the informal restructuring side, and there is the genuine informal restructuring that does go on, which is absolutely valid, and often hand in hand with safe harbour protection as well, because there is risk involved. There is risk involved there. But there's also, and you'll hear practitioners and industry bodies talk a lot about the pre-insolvency advisors out there, which are often associated with these types of structures. We've been pushing a long time to try to get some regulation in that space as well, but at the moment it is unregulated. You don't need to be. Anyone can hold themselves out to be a consultant and an expert in some area, but it's just not a regulated space until a liquidator gets appointed, identifies it, and reports it. I think I actually didn't have too much else to say, but I'm happy to answer questions as long as you like.
As a creditor, sometimes a DOCA feels like a sanctioned phoenix.
Yep.
Is there a fine line?
No, I don't. I don't think so. Personally, look, I'll talk about what we do. A DOCA gets put up, and we're very careful, and we have to be. We're very strict about analysing the benefits of DOCA, because you need to demonstrate that a DOCA is a better outcome than an immediate liquidation of the assets. So the outcome to creditors has got to be superior as a return. And there's a lot of there's investigations going behind that in terms of, that's weighing into account. If you're going to liquidation, there's insolvent trading actions. There might be other recoveries, preference recoveries, unwinding transactions. So we personally do a lot of work to make sure that, if we're recommending a DOCA, which we're required to make a recommendation in our 439A report in terms of the future of the business, we do a lot of work to make sure that creditors are better off, and also that all employees are better off as part of that as well. I guess, and creditors have to vote on that as well. Creditors have to vote on the DOCA. It's in number and value for the DOCA to be accepted. So in the DOCAs I've been involved in, they're always a better outcome than creditors. Now, better outcome to creditors. Now, the other thing is you've got to weigh into account weigh up when you're recommending a DOCA. Yes, on the face of it, there might be insolvent trading claims, there might be other recoveries, but there's a lot of cost and risk around making those recoveries as well, and also in terms of capacity of the counterparties to pay. So there's a lot of things to weigh up there. I think DOCA and Virgin's an example where, I know it's not in the building game, but where you've got a business with a large amount of agreements and licenses, etc., then the DOCA was a vehicle that just made sense, as opposed to selling a business and lifting out and putting all of these agreements over another entity. It just made a lot more sense. But generally speaking, I think DOCAs provide a lot more certainty to creditors as well, other than going down an insolvent trading claim, for example, if that's what you're banking on, and the funding and the drawn out process that can be. So I think there was another.
Thanks, Tim. Just a question on SBRs. They're probably not in Deloitte's wheelhouse, maybe, but do you have a thought on the growing, I suppose, utilisation of SBRs in the market?
I didn't really come. I'd have to have a chat to you after. I'm not too exposed to it. We don't do a lot. I'm not aware of us having done. We might have done one. Sorry, but I'm happy to grab you afterwards and get circle back to you on that. Apologies, I'm not too familiar with the small business restructuring. Righto. I think that was it for me. So if that gives you an early out, that's fine. I'm happy to take any questions or